Hey, so in this video, I want to talk about how to value inventory in a business acquisition. When you're buying a small business, how do you know how much to pay for inventory? And I'm going to do this by utilizing our existing business projection template, which has a valuation tab that helps you value a business using 3 different approaches. So I'm going to show you how that works, but then show you maybe some unique ways to think about how to value inventory. So let me just show you how this template works. And I'll put a link in the description of the video below to this template. This is, again, our existing business template. What it allows you to do is put in historical financial information for an existing business. So historical revenue, historical expenses, and then project going forward. And with that, it'll allow you to create 5 years of projections, and as well as allow you to create this valuation based on 3 different methods. So there's the three methods we're going to typically use is a book value, a discounted cash flow, and a multiple of earnings method. And so let me just walk through those real quick. At a high level, the book value approach is taking your assets minus your liabilities, essentially, and then minus your intangible assets to come up with a book value. So this is like your bare bones selling the business for parts type of a thing. There's not really any like goodwill or brand that you're paying for here. It's just like, we've got some trucks, they're worth X number of dollars. We've got some loans on the trucks that are, less than that, and whatever the difference is, that's the value of the business. That's the type of thing we're looking at with a book value. Now, a discounted cash flow method is highly based on projections. So that's why this works well with our projection template. You'll create 5 years of projections, and these 5 years of cash flow projections are actually being piped in from the cash flow summary tab in this file. And then, so you'll have 5 years of cash flow projections for the business. And then you are going to have to make 2 assumptions, an assumption for kind of what's the ongoing growth rate for the future. And a lot of times I just say pick 3% as the growth rate of the GDP, the gross domestic product. So that's how the economy grows on average 3%. So that's a safe number to pick, that'll grow 3% forever. And then the discount rate, this is very subjective and can be different. Investors will have different discount rates and what they want to consider the discount rate. So this is basically your cost to borrow or raise equity. It's often called your weighted average cost of capital, but essentially it's like what you want to make sure you can at least 10% or at least whatever that discount rate is. And essentially what it does is it discounts your cash flow each year by that discount rate. So ultimately, this will produce a business value based on this discounted cash flow calculation. And then the third and final method that's common is a multiple of earnings. And for small businesses, this is pretty common. So you'll have your revenue and expenses, and then your earnings is basically your EBITDA, your earnings before interest, taxes, depreciation, and amortization. You may also hear of SDE, seller discretionary earnings. This is a similar approach to consider your earnings as the owner. And then you multiply the earnings by some number. And different industries are going to have different multiples. So a recurring revenue software business is going to have a higher multiple of earnings than a trucking business, for example, or than a coffee shop. And so you'll need to do a little bit of research on your industry, but there's plenty of publicly available data on, like, Biz by Sell has a listing of average multiples of earnings that businesses have been selling for in different industries. And so you should be able to find that and come up with some multiples, and that will then essentially, that's just taking your earnings and multiplying by the average multiple here to come up with this business value. And so then what we're doing on this tab is just, we're like averaging the book value of this business, the discounted cash flow method, and the multiple of earnings method to come up with kind of an average between the 3 methods. The reality is that probably you are not going to, my assumption in most small business acquisitions, you're really going to pick an approach. You're either going to value the business based on book value, discounted cash flow, or multiple of earnings. I'd say multiple of earnings is probably the most popular in most situations for small businesses. So take that with a grain of salt. Now, here's what I really want to get at though in this video is that valuing inventory can be really unique. So I'll see clients that come to us and say, hey, I'm looking to buy this business. They want to sell me their inventory. They say they have $1 million worth of inventory. How much should I pay for it? And the seller is starting out thinking, I've got $1 million worth of inventory. You should pay me $1 million for this inventory. And the answer is no, not even close. And so here's the approach I like to think about when I'm thinking about, okay, how much should I pay for some inventory? So let's just say you had $1 million of inventory. Now, what I think you should look at is, what is the business's profit margin? So if they sell $1 million worth of inventory, how much profit do they make on that? Not gross profit, net profit. So their net profit, their net income, that's what I want to look at. And I would say, okay, let's say that's 10% net profit margin. So $1 million in inventory is going to produce, for me as the new owner of this inventory, is going to produce $100,000 worth of profit. So now let's say we're gonna sell. It's gonna take us years to sell this inventory. Maybe this inventory, maybe they have way too much inventory, and we think we'll sell this over 3 years. Okay, well then the value, you need to do the discounted cash flow again for the inventory piece. So if I come back up here, I'm just gonna manually adjust this here. So let's say we think we'll sell 34,000, or we'll make a profit of 34,000 on this inventory in year 1, 33,000 year 2, 33,000, year 3, and then 0 for the rest of these years. And we're gonna have 0 growth rate because we sold all the inventory, and we're gonna do a discount rate of 10%. Okay. So now here's what this is showing the value is, right? The value of the discounted cash flows that you're gonna earn from that inventory, 82,000, right? So that's how much profit you're going to end up making on that $1 million. Now, so I start with that because I want you to see what the value of $1 million worth of inventory is in terms of net income to you. Now, the reality is, if you are going to sell, if you're buying this business and you need inventory, you are going to have to pay for something. You're gonna have to pay for the inventory, right? You're gonna have to pay something for the inventory. So again, what I would typically do then is say, okay, well, I will apply the normal kind of industry standard cost of goods sold to that inventory, right? So if I said, you've got $1 million worth of, this is the retail value, this is what they think they can sell it for. They think they can sell the inventory for $1 million. Okay, if the industry average for material cost is 33%, I will pay you let's say 30%, I'll pay you 300,000. I'll pay you 300,000 for the inventory because I'm going to have to buy that anyway, right? I'm going to have to buy it from somewhere. So I'll pay you the 300,000. And then at the absolute most, if you don't want to make any profit on it, you could pay that total profit that you think you're going to earn, right? If you think you're going to earn 10% net income on that, you could pay, and then you discount that over the 3 years, you could pay this 82,000. So if you want to buy that inventory and not earn a cent of profit, the most you could pay is 382,000, right? And I think for whatever reason, when folks come asking about, they've got $1 million worth of inventory, how much should I pay for it? And they think I don't know if we think in terms of shopping at Walmart or something. And if something's like on sale for 25%, we're excited. You don't want to pay, if you get the $1 million worth of inventory for 750,000, that's not a deal. That's not a deal. So you need to think through this process and just make sure you understand what's the most profit I can actually make after all of my expenses. And the way to think about that is, what's the net profit margin that they've been earning? That's probably what you're going to earn. And what is the industry average that people are paying for inventory, for cost of goods sold? And let's apply that. And let's use that as a starting point for how to value inventory. So hope that's been helpful. It's just a unique thing that I've been running into, and people are just really have varying ideas on how to value inventory. And so it's just something to keep in mind. I wanted to point out. So I hope that's been helpful. If you have any questions, please don't hesitate to reach out at support@projectionhub.com. Thanks.